Stock market volatility. It can be unnerving. No investor, whether they're new to investing or have been making deposits for years, likes to see the value of their portfolio go down, even if they know it's just temporary. When the market takes a turn, some investors will inevitably sell investments in an attempt to minimize their losses, while others will stop making new deposits to their investment accounts overall. Unfortunately, both are big mistakes that can cost you in the long run. In today's video, we'll talk about why you should instead do nothing. Don't make any changes to your strategy. Keep investing regularly, even when the market is down. Why? Well, history shows that markets have behaved pretty predictably in the long run, and investors who stay the course are likely to come out ahead. Dalbar, D-A-L-B-A-R, a market research firm, has done a ton of research on this and found that investors who sell when the market drops, for example, lose about 4% per year by simply just not staying the course. That adds up. So in this video, we'll provide some historical perspectives on market downturns to help you feel more confident about sticking to your investment plan. Market declines can rattle investors, but it's important to keep in mind that they're also very common. The chart here shows the maximum drawdown, and this is the largest loss experienced over a certain period, expressed as a percentage, that's what a drawdown is, of the US stock market every year since 1927, as well as the market's total return in that year. As you can see, it's pretty obvious. Large drawdowns, or declines from a recent peak, are extremely common, and you might be surprised to learn that even years with large declines can still yield impressive positive returns for investors at the end of the year. For example, let's take a closer look at 2020, when the US stocks entered a huge bear market. The market had a big drawdown, a maximum drawdown of 34.3% that year, which is large even by historical standards. It was unprecedented. But investors who stuck it out all year were rewarded with a total return of 24.1% by the time the year was over. It's a massive swing. And of course, in order to get that return, an investor needed to stay in the market to benefit from the recovery. How about 1998? The market was down almost 22% at one point. That was the biggest drawdown of the year. But by the end of the year, it was up over 24%. If you would have cashed out your investments at any time during those big drawdowns, you may have avoided some losses. That's true. But you'd come out way behind compared to just staying invested during the downturn. We'll talk about this a little more later. The lesson here, it's really clear. History shows that if you stayed invested when the market was volatile, you likely came out ahead. If you want more tips like this to grow your wealth, pay off debt, and learn all the financial 101 tools that maybe we weren't all taught in high school and college, hit subscribe and follow along. Historically, the market has gone up in the long run, right? Temporary declines like those in the table can certainly be nerve-wracking. But if you have a long investing time horizon, they're really just blips on the radar. You can see this clearly if you just zoom out of the market. Whenever you look at the history of the market, just zoom out a little bit and look at the behavior of the stock market since, let's say, the Great Depression. What's the overall trend? It's up and to the right. To help you visualize this, we put together a chart showing the value of $1 invested in 1926. We're almost 100 years now past that. The point isn't that you should have invested $1 nearly 100 years ago. That's not the point. Although that would have yielded impressive returns. It's that the US stock market has behaved unpredictably in the short term, but fairly predictably in the long run. Note that the scale of the y-axis is logarithmic, not linear, enabling you to see fluctuations a little more clearly. The box in the top right corner highlights the last 10 years. Of course, the last few years have been extraordinary in some ways because of the COVID-19 pandemic. However, those events have not really altered the overall trajectory of the market. And here, we've zoomed in on the section of the chart covering just those last 10 years, 2012 to 2022. As you can see, the overall trend of the broad US stock market is still very clear. It goes up. History has shown that even in the case of a bear market, which is a decline of 20% or more from a recent high, the market tends to recover much faster than you might think. In other words, if you sell when it falls, you'll likely miss that recovery. So the bottom line is that market declines are an opportunity. We encourage you to see short-term stock market declines as this big opportunity. If you keep putting money in the market, you effectively get to buy investments while they're on sale. Plus, you can lower the taxes that you'll pay with tax loss harvesting. Wealthfront offers automated tax loss harvesting, a service that's like getting an extra 1.8% on top of your returns. Periods of volatility are also a good reminder of the importance of diversification, or buying a wide range of investments instead of focusing on a single company or sector or geography. You gotta diversify. Diversification can increase your risk-adjusted returns and, to some extent, insulate you from some losses during those drawdowns. When you feel insulated from losses, it's easier to stay invested, which is really the key to investing success. You might hear people talking about, buying the dip or waiting until the market bottoms out to begin investing again. This sounds great in theory. It really does, but it rarely works out in practice. The reason is that it's virtually impossible to tell whether the market has hit bottom or will continue to fall in the moment. No one actually knows in that moment. There's also the opportunity cost of sitting on uninvested cash waiting for the bottom. Unfortunately, research has consistently shown that timing the market, it just doesn't work. Even most professional investors cannot consistently get it right. That's why we think it's wise to stick to your investing plan, regardless of what the market is doing. It's just almost nearly impossible to time that bottom. Here are some investing keys to remember. Having a long-term mindset can help you make more informed investment decisions. Timing the market is basically deciding when to get in and out and trying to time that perfectly. And the reason why it's tough to time it is because no one knows when the best or worst days will be. And that's one reason why investing regularly over time, or even using recurring investments, can be super helpful. You might make an adjustment and come out ahead. Some people actually do, but the majority of us will end up negatively impacting our returns in these cases. The most common way investors do this is by selling when the market goes down. It's human nature to feel the need to protect your principal. Trust me, everyone feels that way. And you feel the need to stop any potential loss, so I get it, it does make sense. Now, a question we often receive is, why can't you just sell off on the downturn, and then when the market reaches the bottom, you'll redeposit your funds and then take part in that upside, right? Sure, again, if you know exactly when the bottom is, then of course this scenario is ideal. But no one actually knows where and when that bottom is during big market drops. So it's not that you don't know when to sell off, it's that you don't know when to get back in. In the market, it tends to recover super fast, way faster than you might think. So you likely end up getting back in too late and then missing out on that quick recovery. So the key here is just to stay invested so you don't miss the best market days. It's really that simple. And if you're going to stop investing because of a volatile market, you'll end up with a lot of uninvested cash and some taxes while you're at it. And if you're sitting on cash, you run the risk that the market will go up while you're waiting on the sidelines. And then if you try to time the market, you'll likely stay out of the market too long and miss out. To reinforce this idea, let's look at an example that shows how much it would have cost an investor to miss some key days of surging prices. In this table, Putnam Investments evaluated the performance of the S&P 500 over the 15-year period ending on December 31st, 2021. This represents nearly 3,800 days during which the markets were open. If you stayed invested the entire time, a $10,000 investment would have multiplied to $45,682, a 10.66% annualized return. If you would have missed out on just the 10 best days, just 10 days, you would have had $20,929, almost 25K less. The more best days you miss out on during that time period, the worse off you'll be. So how is Wealthfront built for this? When the market gets volatile, you should use an investment service that optimizes your investments to not only withstand the market swings, but also take advantage of big downturns. The first key to this is diversification. This is that risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio typically contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. Wealthfront offers a variety of automated investment accounts consisting of globally diversified low-cost index funds. The next key here during market volatility is tax savings. This one's huge. Wealthfront offers tax savings tools that look for opportunities to save you money. This tool, tax loss harvesting, can help you build up tax savings over the long term. When you claim a loss on an investment, you can offset your tax bill at the end of the year, which means more money to reinvest. And on average, we've added an extra 1.8% to our clients' after-tax return every year. Another key is automated investing. Wealthfront offers the ability to set up recurring deposits, so you don't have to worry about deciding when to time the market. On the other hand, if you like having more control over your investment timing, Wealthfront also offers fast money movement into the markets when you see that buying opportunity. For example, when you transfer cash from the Wealthfront cash account into your investment account, your funds are typically invested within just a few minutes. I hope this video helps you make sense of all the big headlines and the huge market volatility we've seen here in 2022. So whether you're watching this in 2022 or down the road, just remember this: staying invested, taking advantage of time, and not getting in and out of the market, those are the keys to long-term investing. And while you're at it, use a tool that also takes advantage of those market dips. Wealthfront's got your back there. I'm Tony from Wealthfront. Take care.